Hello and welcome to the i3 podcast. My name is Wouter Klein and I'm the Director of Content for the Investment Innovation Institute. For more information about our educational forums for institutional investors, please visit our website at www.i3-invest.com. There you can also subscribe to our complimentary newsletter i3 Insights, in which we discuss investment strategy and asset allocation questions with asset owners around the world. Now, as you all know, we love our disclaimers in this industry, so here's ours. This recording is for educational purposes only. It does not constitute financial advice. Please enjoy the show. This podcast was sponsored by HMC Capital. As such, the sponsor may suggest topics for discussion, but the final control over the content remains with the Investment Innovation Institute. Welcome to the i3 podcast. I'm here today with David Di Pilla, Managing Director and Group Chief Executive of HMC Capital. David, welcome to the show.
Thank you.
David, you're one of the founders of HMC Capital. Can you tell us a little bit about your background? You've worked at UBS before as an investment banker. How did you get involved with HMC Capital?
I had a long career in investment banking at UBS, and back in 2016-17, I put a consortium of private investors together to acquire a property portfolio that came out of the failed Masters home improvement business that was put together by Woolworths. What we spotted at the time was a very unique opportunity with some of the best real estate in Australia in some of the best growth corridors of Brisbane, Sydney, Melbourne, Perth. And we acquired that portfolio at a very attractive entry level. Went about a process of repurposing and repositioning the real estate into what we called our daily needs strategy, which today is built into a $5 billion listed REIT. And so that ultimately resulted in the creation of HMC through a group of private individuals.
Yeah, so that's interesting. Why did it not work for Woolworths?
Oh, that was an operating business. That, what they did. The operating business was basically a challenger to Bunnings at the time. It was a structurally very competitive market, and probably there wasn't room for a second major player in that retail space. But the one thing they did incredibly well was they put a great portfolio of real estate together, which we identified, we picked up at an attractive valuation, and we rebirthed as HomeCo Daily Needs. And obviously it's been a great success story over the last 5 years, ever since we created that entity. So as a real estate play, it was great real estate.
So that was the start of HMC Capital, but it was also at a sort of a tricky time. I think the initial process started in 2016-17, but then the company listed in 2019. And of course, since then we had like a global pandemic, COVID hit, we had interest rates go up. What sort of challenges did that provide to growing the business?
Well, I think initially in 16, 17, 18, when we were setting up HomeCo up, it was a fairly challenging time in the market. Capital was hard to find in Australia. There was also a lot of consolidation going on in the retail industry. So we'd cut a lot of deals with various retailers to come into our real estate because of that consolidation. And there was a couple of major retailers went broke in Australia, so we lost some tenants there. So as a result of that, we had some early challenges in terms of creating the portfolio and the platform, but we overcame those because of the quality of the real estate, the quality of the strategy, the convenience-based nature of it. So we got it up and running, listed in 2019. Then we had this little thing called COVID-19 come along in 2020. That really knocked real estate landlords around, particularly if you were just a very early stage business in the early stages of your development. We didn't have a lot of fat in the structure at the time, but we were able to absorb it, readapt, reposition. We reframed our narrative, went down the path of creating REITs, listed REITs, using the cost of capital through that, releasing capital back and created the management company that we have today. Yeah, and I'm very proud of the fact that we were able to adapt, and we were very nimble, fleet-footed, and adapted to market circumstances pretty well.
Yeah. So the company today invests in a number of different types of assets. So we touched upon real estate, but you're also active in private equity and even in listed securities. What is sort of the overarching investment philosophy that ties it all together?
Look, it's a very simple philosophy. We're really looking for high quality opportunities with structural megatrends underpinning them. We like real assets. We like fundamental, high-quality businesses that we can own forever. Now, whether that be through our private equity strategy, where we're buying stakes in listed entities, we're looking for listed entities with basic fundamentals and drivers around barriers to entry, great quality customers, underlying growth drivers. So businesses that we're prepared to own forever. Overlay on that the fact that we do like real assets. We've built a bit of expertise there. But I've always been a great believer in structural megatrends and growth drivers. If you have an unanticipated event in your business, if something goes wrong and you've got fundamentally growing businesses and fundamentally growing cash flows, that will always stand you in good stead when you get an unanticipated event like COVID, when you get 13 straight interest rate rises. If you've got a growing business with underlying megatrends, you will generally be able to get through that unanticipated event. And it's the same for real estate. We've picked sectors that have got fundamental growth drivers rather than sectors that have got structural headwinds.
What are some of these mega trends? What are some of these drivers that you invest in?
The two we've focused on in the real estate space have been built around the daily needs space. We think COVID-19 has really changed the way people behave, the way people go about their daily life. That migration every day, Monday to Friday, from the burbs into the city, it's probably reduced a bit. So people are staying closer to home. People are not making that migration every day. They might do it 4 days a week, 3 days a week. They might do it for reduced hours. So as a result, the assets that we have built our daily needs strategy around out in the suburbs of Australia, in the growth corridors of the major capital cities, have really flourished as a result of that. And we believe that becomes an increasing mega trend as these cities intensify. Brisbane, Sydney, Melbourne, globally important, globally relevant cities. Melbourne and Sydney would be the fourth and fifth biggest city in the US if you were to overlay them on a map of America. Yeah, so right. As the population in Australia continues to grow over the next decade, the value of our real estate will continue to grow. The need for it to be used as part of the last mile logistics for B2C customer delivery will increase, the rents will increase, and the value of the real estate will continue to go up. So that's one megatrend we've really identified. The other is clearly healthcare. We like that as a thematic, just the sheer drivers around population growth in Australia, 500,000 net immigrants next year. Add on top of that an ageing population. Add on top of that medical advancement and increased medical intervention. Add on top of that the fact that increasing knowledge and understanding around wellness. So the demand for healthcare real estate, we think, is just a significant structural megatrend, and we want more exposure to it. Importantly, there are very few specialists in this space in Australia or globally to get exposure to high quality portfolios. We've identified that as an opportunity in the market, and we're really putting a major emphasis around that in our business and our future growth.
So daily needs, is that things like groceries, or what does that include?
Yeah, it can be groceries, it can be a medical centre, it can be a pharmacy, it can be a childcare centre, it can be a gym, it can be anything that you need to go and visit on a regular basis. You may not go there every day, but you maybe have multiple visitations a week. Our daily needs strategy at HomeCo Daily Needs REIT, which we have, which is also ASX listed, I think over the course of this year there'll be 80 million visitations to our assets over the course of this year, which is good for something that 5 years ago was just basically an idea.
Yeah. So is this linked to this concept of the 15-minute city where everything is close by? Is that sort of the type of businesses?
Exactly. We didn't come up with that concept. We built our strategy years ago, but we believe in that sort of concept. We believe in consumer choice. We believe in consumers being wanting instant service, instant gratification. If I want to buy something, I want to try and get it delivered this afternoon. I want it delivered within a half-hour window. I want to know that if I'm at home, it'll arrive on time. The only way to get to that place is using bricks and mortar real estate that is located close to where people live. So we believe we touch something like 15 million Australians within a 10 to 15 minute drive of our portfolio of daily needs assets. So we think we're very well placed.
Related to that concept is also this idea of the last mile logistics. Now that came up very strongly during all the lockdowns when people really were reliant on that. Is this still a strong enough trend to sort of have future growth in it?
Oh, massive amount of growth. It's only just starting. And what we talk about is the fact that logistics, real estate has become pretty on trend and very hot over the last few years. Cap rates and returns have been bid down to very, very low levels. So investors are really seeking exposure to that because of the underlying mega trend, because of e-commerce and because of a lot of those factors. What we believe is that is very hotly contested and very tightly bid. That's B2B logistics. What we're focusing on is business to consumer logistics, which is really a sector that has not at any way been sort of institutionalized yet. There's very little focus on it. We see massive opportunity for significant tightening in cap rates and asset values to re-rate quite materially over the coming years. We've been a first mover in that space. We've now got a very significant portfolio. We've got a very clear focus around it. We've got real alignment and partnership with major retailers in Australia. So we think the future and the outlook for that is very, very bright.
Is there a certain element of geography to it in the sense that, you look at Sydney and it has all the inlets of the rivers. Does that make it harder to sort of place these type of real estates closer to urban centres?
That would be one way of explaining it. The way we would explain it would just be the sheer size and scale of the metro area in Sydney and Melbourne, particularly Sydney, where geographically you've got a very dense urban population. If you live in the western suburbs of Sydney, you're now spending well over an hour of commute into the CBD of Sydney every day. If you live in, say, the southeastern suburbs of Melbourne, you're spending an hour and a half commuting to the city every day. So the reality is if you've got the option to work from home, if you've got the option to stay closer to home, and these cities are getting harder and harder to move around, B to C, last mile logistics is the way of the future. It is not possible to be delivering products out of one central warehouse in Sydney or Melbourne to consumers in any kind of rapid time frame. So we believe we've identified a mega trend. We think it's one that's really on point, and we think it's one that's going to flourish over the next few years.
The other mega trend you mentioned was around healthcare and the life sciences. And I believe also this is the area where you have some of your institutional clients involved, which particularly centered around sort of a portfolio of health scope hospitals. How did you get the institutional involvement involved in this case?
Look, healthcare is clearly a sector that I've touched on many times in recent presentations that we've given and to the market that has a structural megatrend underpinning it. The characteristics and fundamentals of the asset class are compelling. Population growth, ageing population, increased medical advancements and medical intervention, and increased focus by people on their wellness. As a result of that megatrend, having exposure to healthcare real estate is something that most institutional investors, when you go and present to them, give you a big tick around. The hard bit is, how do I get exposure to a portfolio of healthcare real estate assets at the right price? That becomes quite challenging. Easy to say, easy to come up with the thesis, very difficult to deploy and provide investment opportunities around it. So earlier this year, this HealthScope portfolio of assets came to the market, and we put an offer to the vendor, which is a US-based property REIT. We acquired the assets on very attractive terms. As a result of that, we then had the seed basis for a very high-quality portfolio of assets to seed an unlisted institutional REIT. We're in the process over the course of the next few weeks, through the back end of September 2023 and early October 23, in closing an institutional fund, $1 billion fund seeded with those assets. There'll be investors both domestically here in Australia and globally. So you'll have a global sovereign wealth fund investing in that. You'll have a global multinational corporates pension fund. A couple of multi-managers will be involved, global multi-managers, and a domestic Aussie super fund. So the reason they've all invested is because, one, they like the mega trend and the thematic around real estate, healthcare real estate, but they also like the seed assets going in and the fact that we're able to put a high quality portfolio of assets together in at the right price and an attractive valuation.
Another big mega trend, of course, is climate change, and related to that is the energy transition, where we move to more sustainable forms of energy generation. And I think you're also playing into that theme with looking at basically opportunities that companies that benefit from the energy transition. To a degree, that it's also a bit of a story of still technologies that have to be developed and innovated. Is there enough breadth to invest on those winners of the energy transition?
I think energy transition is a bit of a catch-all. It's something that now, with the commitments that Australia has made to zero net carbon over the next decade, and a lot of capital has got to flow into that sector. A lot of resources and a lot of effort and a lot of energy have got to go into those areas. You can play energy transition in many ways. You can play it through investing in assets. You can play it through technology and technological advancements. At this stage, technology is really more built around assets. It's more things that we can really see and feel and touch. It's things like investing in wind farms, it's investing in battery storage, it's investing in solar. Over time, as that technology changes and improves, the types of investments that we'll be looking to make will change and evolve. At this stage, what we're looking to do is we're looking to play that space in many and varied ways. It's still very early days for us, but as a landlord and as a real estate owner, we've got an immediate need for energy transition credits. So as a result of that, we're really thinking about how we can basically work with investors to bring some of our own demand together with some of the megatrend opportunity there, and potentially we'll be looking to launch a fund around that later this year or early next year. So it's very early days at this stage for us. It's an area we've identified, it's an area we want to move into, but at this stage, it's something that we'll look to put more detail around later this year, early next year.
You also are active in the listed space,
yeah,
and you bring a bit of a private equity approach to the listed space. So can you tell me a little bit about how that works? I think you described it as target undervalued companies that are rich in assets, but what is sort of the catalyst there to make them grow?
About 12 months ago, we launched HMC Capital Partners, which is an entity that we established to take high conviction strategic stakes in listed entities. We're looking for listed companies with asset backing, where we can get investment exposure at or around asset backing. So we obviously look for opportunity asset rich companies where we believe they're trading for whatever reason at or around their asset backing. So we're looking for opportunities where if we get the investment thesis right, the upside can be quite asymmetrical. We're looking for businesses that are high quality businesses that we're prepared to own for a long period of time, where they've got barriers to entry, they're businesses with pricing power and ultimately underlying growth fundamentals. But again, asset backing is important to us when we look at these investment opportunities. So with that starting point, we've identified a number of these opportunities. We've taken a 19% stake in a listed entity called Sigma Healthcare. We've taken 4% of Lendlease, and we've got some other unidentified investments at this point that we've got that fit our investment thesis, that we believe are trading below fundamental value, and we believe will deliver our investors some very attractive returns over the coming years.
Yeah. So you got listed assets, you got private equity assets, you got REITs, you got unlisted property. Are you relatively agnostic to whether it's a public market asset or a private asset?
Look, I think the ability when you're an alternative asset manager to be able to span both listed and unlisted markets is really important. What I would say is from a market point of view, the listed market generally at any moment in time is trying to price a series of future cash flows in regard to a public stock or a bond for that matter. So you're getting real-time pricing and you're getting a point-in-time view on future cash flows. As a result, the listed market can sometimes over and undershoot, whilst over the long term, the market will always be rational and always revert to its long-run pricing. In the short term, you can sometimes get moments of mispricing. We believe that exists at the moment with the current rate hiking cycle. We think that listed real asset-based companies have probably been oversold because of a view as to where the peak rate cycle will be. We believe we're close to now the peak rate cycle. So we think over the next 6 to 12 months, real asset-focused businesses with more interest rate sensitive cash flows like REITs, real asset companies with infrastructure-like characteristics will actually outperform the market over the next couple of years. And that's why we've focused a lot of our investment thesis and a lot of our attention into that space. So we think that is one way to play it. The other way to think about it is there are other times in the market where the pricing power and the cost of capital in the listed space can actually be very strong. And so to have that kind of currency to take advantage of those opportunities is also important. So at the moment, we're probably a buyer of listed real assets. At other points in time, we might be a seller of those opportunities.
Now, there's a lot of attention as well by the regulator on the valuation frequency of unlisted assets, partly stemming from the pandemic when some of these assets potentially could have been mispriced. Do you have any sort of strong views on frequency of valuating unlisted assets?
Look, I think, as I said earlier, the listed market gives you a point-in-time view on valuation. The unlisted market, most unlisted investors, whether it be an institution or other unlisted syndicate-type investors, will revalue their assets on a regular basis. It might be every 12 months, for example. What they'll do is they'll go to an independent valuer and they'll get a confirmation of the underlying value of that asset. A valuer, however, can only give you a value based on market evidence and data that they can observe. If there hasn't been a lot of market evidence or the market's taking time to catch up or because of the dislocation over the last couple of years around interest rates moving up, sellers have not been selling as actively, the evidence will not be there. And therefore, there'll be a lag in terms of the catch-up, in terms of where those unlisted assets will be held. So that obviously means that you can criticise that, but it's just a function of the market. It's a function of the investment environment. And what you really need is you need managers and investment professionals that can look through all of that, look at what the listed market's doing, look at what that's telling you, look at the lag effects that can sometimes take place in the unlisted market. We like all that market dislocation because it actually gives us lots of data, lots of information. And because we're flexible between both markets, we've got both institutional unlisted mandates, we've got listed REITs. We think there's an opportunity to create value and arbitrage those two market opportunities at various points in the cycle.
Yeah. Can you tell me a little bit about your plans for future growth? I believe the company has a target to reach at least $20 billion in assets under management. What is sort of the time frame that you're looking at?
We listed HMC back in October 2019. The group at the time had about $800 million of assets. We've grown nearly tenfold since that time, over just over 3 years, from 800 million to 8 billion today. We believe that if we focus on structural mega trends and if we focus on sectors that have got underlying growth drivers, but we also provide great returns for our investors and keep delivering for our investors, we'll naturally, organically be able to maintain the growth trajectory that we've been on. But we don't take that lightly. We don't throw numbers out lightly. What we believe is if we do a good job, if we're good custodians of capital will find us and we'll be able to continue that growth momentum beyond the sort of $8 to $10 billion as to where we're at today at the end of 2023, where we are now. We're not really putting any kind of cap or ceiling on our view. We just need to do a good job and the capital will find us.
Yeah, fair enough. And are you eyeing any new strategies? I could, for instance, think of the popularity at the moment around residential property. You do a lot of property investing. Is that something that you would consider?
Look, the areas that we're sort of focused on as a business are around, one of the areas that we talked about a little earlier and we flagged to the market is we will look to launch something around energy transition. So we'll look to bring a fund to market later this year, early next year. We're looking at debt, real estate debt exposure. Again, we just think it's probably the wrong point in the cycle to be launching something around that space. We think that there could be some pain to come there. A lot of loans written over the last few years in a fairly benign interest rate environment, that once refinancing starts to happen and some valuation softening in real assets starts to kick in, there could be some real pain there in some of the loan books around the market. So we're just watching that very carefully and looking for a moment in time to play there. Other areas we sort of think about are, adjacencies to real assets and some of the other businesses we're in. Residential, probably not going to go and play standard residential assets, but we have identified some other pockets of that market exposed to that subsector that we think could present some attractive opportunities. So areas like build to rent could have some interest for us over time, or even manufactured housing and other sub pockets of that thematic where we think there could be some interesting value in the future.
To what degree does the investment environment come into play as well when you sort of look at future growth? I mean, there's still relatively high inflation. Are you worried about that going forward?
Absolutely. Every time we deploy a dollar, we put forensic thought into the market outlook and where we think the market's going, where we think we're at in the rate cycle. What we obviously then overlay the macro onto the individual investment thematic that we're undertaking and the individual opportunity. So we do bottom up in terms of the opportunity, but we do a lot of thinking around the macro and overlay those two things together before we deploy any marginal dollar in the group. I think we're pretty proud of the fact that we do a lot of internal questioning and a lot of debate and a lot of discussion goes into any new thematic or any new product we launch. And then once we've launched it, any underlying investment we make, we put a lot of scrutiny into it. So importantly, we do put a lot of thought and a lot of store into that. Where do I think we're sitting at the moment? We're clearly through peak rates. We're through peak inflation in my view. We're on the downside of that mountain at the moment. But the question is really more one around how much longer is there to go in terms of this elevated interest rate environment now. You know, I think you're going to see interest rates remaining at the current levels for very much the best part of 24. You might, who knows when that easing starts. I can't predict that. I don't think anyone can predict that. But what you can do is you can obviously have a view, and then you can set your investment strategy around that view. And that's what we like to do. We like to form a view internally. We like to take a view, and then we like to act on that view.
Now, of course, a lot of the asset owners are also very focused on sort of the ESG credentials, and the net zero journey is a big part of that. I saw some information from your company that thinks that maybe HMC Capital can already reach net zero by 2028. Is that right?
Our real estate strategies, yes. We, in regard to our daily needs REIT and our healthcare REIT, we've come out and said we're aiming to be zero net carbon by 2028. We're undertaking a lot of internal initiatives around getting our Scope 1 and Scope 2 emissions down, and we're on a trajectory to achieve that internally with just some very smart technologies. So we're putting energy management systems in across all our assets. We're putting solar in across our assets. We've got very environmentally friendly buildings in that we're very efficient around capturing rainwater and those sorts of things. So there's a lot of base initiatives across the business. Those energy savings that we put into our underlying real estate get us so far down the track. They don't get us all the way to zero net, in terms of our emissions. But what we're then looking to do is, through other initiatives that we've got underway, really looking to abate the balance of any emissions through assets that we either invest in or manage over time. So we're pretty focused on that. We haven't really announced what we're planning to do there, but we've got some interesting initiatives there, and we've got some pretty ambitious targets. And we're working pretty hard toward them.
Yeah, excellent. Well, David, thank you very much for your time.
Great.
It was good talking to you.
Thank you. Thanks.
Thank you for listening to the i3 podcast. For more information, please visit www.i3-invest.com. Thank you very much.